All right, welcome once again to macroeconomics. Uh, so, for just a brief background on what this module is all about. So, we understand that the subject of economics can be categorized into two broad subjects. We have what is referred to as microeconomics, then we have what we refer to as macroeconomics. So, with microeconomics, is the section of economics that deals with the individual elements within an economy. And on a macro level, when you're dealing with macroeconomics, we are dealing with the whole economy aggregated as a whole. So you'd find out that when you're talking about elements like demand, for those that did economics 1A, which is microeconomics, in economics 1A, we're looking at individual demand curves, individual demand within markets, as well as market demand. But we're not getting to a macro level where we'll be looking at the total demand within an economy. The same applies with elements like supply, production, etc. So now when you're looking at macroeconomics, we are looking at the economy or at a broader perspective or at a broader level. So usually when you're talking about the subject of economics, it can be best explained using what we refer to as a circular flow of income and spending, which basically represents all of the activities that takes place within any economy. So any activity that you think of within an economy can be best explained by the circular flow of income and spending, which is presented on your screen. I didn't ask if my screen is visible. For those that might not be viewing my screen, can you please highlight? And if you are able to view my screen, just allow me to continue. All right, so this circular flow of income and spending highlights the major activities that happens within an economy in terms of the participants that we find within an economy, as well as the markets that get then formed within that particular economy. So for a simple economy, we use what we refer to as a two-sector model, which can be expanded to a three-sector model, which includes now the government. So in any economy, we have two main participants, which are the households and the firms. And we have auxiliary participants like your government and your foreign sector when we have an open economy. But in a closed economy, we usually have two main participants, which is the households and the firms. So what happens within these elements is that with the households, these are referred to as the owners of factors of production. And for those that were in the classes of Economics 1A, we explained what factors of production are, which are the resources that are used to produce goods and services within the economy. And for factors of production, you have your elements like your land, your labor, your capital, your natural resources, your enterprising skills. Those are the main factors of production that you find within the economy, and they are owned by these individuals that we refer to as the households. So these households supply the factors of production which are required by the firms in order for the firms to produce goods and services, which are then used within the markets by either the firms themselves, if it is capital goods, or the households themselves, if it is what we refer to as consumer goods. So the interaction between the firms and the households create what we refer to as an economy. So we understand that the firms then in what is referred to as a goods market. So within a goods market, you'd find out that this is where the goods and services are provided by the households, and they provide elements like any consumer goods that you'd want to consume, either it's foodstuffs, it's any clothing, motor vehicles, etc. Anything that the households would be consuming, and that is created in what is within the factor market. This is where you go with your labor skills or your skills that you have, where you have acquired your skill, your degree from Mancosa, and you're now viewing yourself as an employable person. You get into the factor market and you offer your skills, and the firms hire you from the factor market. So basically, that is where the factors of production are obtained from by the firms. So other elements that are offered within the factor markets include elements like your natural resources, etc., depending with which type of market that you're talking about. So basically, the interaction between these two creates what we refer to as an economy. And within an economy, you'd find out that there's no economy that would operate without some form of regulation, some form of laws that are enacted in order to ensure that the economy is functioning properly. So you'd find out that that is where the government now comes into play. The government comes in as an enforcer of the laws and as an enforcer of property rights in order to ensure that the activities that happens within the economy are properly regulated from the pricing structures, from the ownership structures, as well as the elements like the provision of certain goods and services that are not provided by the private sector. For example, you have elements like your road infrastructure, your municipal services, etc., etc. So that's where now the government comes into play. And for it to be able to raise funding for that, it needs to tax these individuals, it needs to tax these firms that are operating at a profit. So you'd realize that that would also be enacted from the different objectives that emanate from these participants that we have. So with households, they have their objectives that is mainly centered on satisfying their needs and wants. And for the firms, their main objectives are mainly centered on obtaining a profit within an economy. So you'd find out that there's a diversion in terms of the two objectives that the two individuals or the two elements or the two participants have within the economy. So if the household wants to satisfy themselves with needs and wants, you'd realize that they would be looking for something that is so cheap to the extent that firms would not be able to make a profit. And the firms would want to maximize the profit to the extent that they would suffocate the incomes of the household. So that's where now the government comes into play. I think this particular section is covered in microeconomics. We'll be looking at how the government intervenes in order to control the pricing, etc. But in this element, we'll be looking at the elements in relation to what we refer to as the public sector, the role of the government within the economy, as well as looking at the rationale behind the involvement of the government within these particular markets, as well as other elements surrounding the government raising of revenues, etc., and how they spend their revenues, which we refer to as the fiscal policy. We're going to be looking at that one later on. All right, so having thus laid this background, we can now look at the elements that we are required to be looking at in terms of this particular module. So this background is very, very important because it gives you a clear picture or a summary of all the topics that we're going to be looking at in terms of this particular module. So this module is divided into 9 sections, and these 9 sections cover everything in relation to an economy. So the first section that we're going to be looking at today, we looked at it the previous section, but we're going to delve much more deeper, is measuring the performance of an economy. How do we measure if an economy is performing very well? How do we measure if an economy is underperforming? And what are the main highlights that highlights the performance of an economy? So move away from that, we look at what we refer to as macroeconomic objectives. So with macroeconomic objectives, these are the main objectives that any economy is expected to be achieving if it is to be deemed successful. I would want to ask some that have just joined, if you can mute your microphones, that would be of assistance so that you do not disturb the flow of the session. Right, so with the macroeconomic objectives, these are the objectives that we look at if you want to assess whether an economy is performing very well or whether an economy is underperforming. So I'm just going to give a brief highlight on each objective, what we're going to be looking at, then get into the first objective, then try to look around it and some of the important aspects surrounding it. So with the macroeconomic objectives, we have 5 main objectives, which include economic growth, price stability, full employment, as well as external stability and equitable distribution of income and wealth. So with economic growth, there is something that just comes into your mind, or that just gets tickled in your mind when you hear the term economic growth. So I'm sure the term looks self-explanatory by itself. So basically, in terms of economic growth, we'll be looking at whether an economy is growing. And there are many metrics that are used that we're going to be looking at. in terms of how we measure if an economy is growing or if an economy is not growing. So I'm sure you've heard about economic growth when the finance minister is presenting their budgets at the end of the year or in the midterm. Even when the South African Reserve Bank presents their statistics, they talk about this element called economic growth. So with economic growth, basically we're basically stating that the economy is growing. And what is it that we're looking at when we're saying that the economy is growing? So in terms of economic growth, there is a metric that is used to assess economic growth that is called GDP, or gross domestic product, which we're going to be looking at in greater detail and how it is used to measure economic growth. So that's just a brief highlight on economic growth. Then with price stability, we're trying to look at whether the performance of the prices are in line with the objectives within the economy. So we understand that when it comes to price stability, we're looking at whether the prices are stable within an economy, not necessarily prices going down or not necessarily prices going up, but having a stability within the pricing system within the economy. We understand that the most inevitable thing within an economy is prices going up, especially if it is a free market economy, where sometimes the forces of demand and supply are allowed to operate on their own to determine prices. We'll be having prices either going up or down. So that cannot be avoided at all. But what is important is looking at what we refer to as the general price level, which is the general pricing within the economy, whether the prices within the economy are generally going up or are going down. So we'd want to maintain a balance between the upshifts of the price and the downshifts of the price, because we understand the repercussions that comes along with that. If prices are to go up, if the general price level is to go up, you'd realize that that would increase the cost of living within an economy, as we have been realizing the past 3 years. Just to take a note, how the prices were just generally going up. If you look at the price of petrol, how much the price of petrol was in 2020 and how much it is currently per liter, you'd see that in terms of an individual commodity, in terms of petrol, you'd see that the prices have generally been going up. And that contributes immensely now if you're looking at a broader range of prices, that is maybe the price of bread, the price of electricity, the price of water, etc. So if all those goods are to go up in terms of their pricing, it means that we're having what we refer to as inflation within the economy, which is not a good phenomenon within an economy. So basically, we try to ensure that an economy is having stability in prices. So we're going to be looking at that one later on. Then we have an element that we refer to as full employment. So with full employment, we're trying to look at the extent to which the economy is able to absorb the labor force or the factors of production within an economy. So in terms of the factors of production, we mainly look at the labor force, because that is the most element that affects many aspects within the economy in relation to the standards of living that people end up living, as well as other social factors in relation to the crime rate, etc., if people are not employed. So basically, we look at the employability rate of the labor force and try to ascertain whether that unemployment rate is growing or is not growing or is dwindling. And obviously, in terms of full employment, we'd want to ensure that every element within the labor force are absorbed within the systems, within the factors that we have, factor markets that we have. So again, with full employment, you'd see that it is also connected to economic growth. If the economy is not growing, you'd see that it is difficult for the economy to absorb all of the skills that are available, like what is happening currently in this current nation. We'd realize that the unemployment rate has been growing, etc. So you'd find out that all of these elements would be emanating from the contraction maybe that was happening during the past few years within the economy, or might be aligned maybe to certain sections within the economy that needs to be addressed in order to ensure that the employability of the individuals increases within the market. So we're going to be looking at unemployment as a topic, and we're going to be delving much more deeper into that. Then we have what is referred to as external stability. So with external stability, we understand that an economy does not operate in a vacuum. It operates in conjunction with other economies, with other countries. The South African markets trades with the BRICS market, it trades with the European market, it trades with China, it trades with the US. So in general, we understand that no economy operates in a vacuum. So in terms of that, that means that there are either goods that are coming into the country or South Africa coming from other economies, or we are exporting goods to other countries that are coming from the local economy, and hence as a result, that would affect the matrix in relation to other economics objectives like economic growth, price stability, full employment. If we are to look at elements like if the economy is importing more goods than it is exporting, that creates an imbalance within an economy, which is sometimes referred to as a balance of payments deficit, which creates a phenomenon that we are consuming goods that are coming from other countries rather than us exporting goods to other countries. That means that as we are importing, we are paying, and there's an outflow of cash, there's an outflow of resources from the local economy going to other economies, thereby that contracts the local economy if we are importing more than we are exporting. And if we are exporting more, it means that our economy is likely going to boom and to grow, because other economies are interested in what we are providing locally, and hence as a result, that would at the end of the day create economic growth, that would create employment for the local economy, and hence as a result, you'd see that that is part of the macroeconomic objectives within an economy. Then last but not least, we have what is referred to as equitable distribution of income and wealth. So with the equitable distribution of income and wealth, we're trying to look at if the economy is growing, is the economic growth inclusive of all the aspects within the economy, all the different income groups within the economy being included in terms of the economic growth. So we understand that in terms of inequality would exist whether we would like it to exist or whether we would not like it to exist, but it has to be within certain reasonable range. So you'd find out that in terms of that element, I'm sure for those that reads the Bible, there's at some point where Jesus said that the poor you always have with you, indicating that you'll be having different dimensions within an economic system that you'd find within any economic system. So you find out that within an economic system, there's some form of inequality that would exist, but would want to minimize that level of inequality within the economy. So that would be analyzing using elements like your Gini coefficient. So we're going to be looking at that one later on. Your Lorentz curve, drawing a Lorentz curve, etc., and how it denotes in terms of the objectives with surrounding an economy. So these are basically the main highlights of what we try to look at when we are looking at the performance of an economy. Right, so from there, I just want to focus a little bit on the aspect of economic growth. The aspect of economic growth, and explain a few things there before we can look at some of the exam type questions that you're likely going to meet in relation to that particular topic. Right, so in relation to economic growth, economic growth is defined as the increase in real GDP over and above the previous year's GDP. So that is the definition that you can give to economic growth. If the GDP is growing, it means that the economy is just generally growing. So we're going to be talking about the aspect of GDP, what GDP is, and how we can measure this phenomenon that we can use to measure economic growth that we refer to as gross domestic product. So GDP simply refers to gross domestic product, and by definition, it refers to the total value of all the final goods or services that are produced within the boundaries of a country in a particular period, and that is usually in a period of a single year. So you'd find out that in terms of the definition of gross domestic product, you need to understand that this is the total value of all the goods and services. So when you're saying the total value of all the goods and services, we are not looking at only one particular product. We are not looking at fuel, bread, no. We are looking at all the products that are being produced within the economy of South Africa. We are looking at the total value that is produced in the agricultural market, how much value of wine has been produced in Cape Town, how much pigs have been produced in various agricultural farms along the South African spectrum, how much cars have been produced within the South African market, how much timber has been produced. So we're trying to aggregate all of the production that is happening. And the production is not only associated with goods, physical goods only, we also look at services. We're looking at also how much the banking sector has contributed to the South African economy, how much the insurance industry, how much all of the services that are provided within the South African market are contributing to the economy. So basically, we're trying to aggregate the total value, and this value has to be the value that has been produced within the boundaries of South Africa. So basically, we're not looking at how much has been produced in terms of wine that has been produced in Germany. No, we're looking at only what is being produced in the nation of South Africa. So this gross domestic product is basically the total value of all those goods aggregated, and that total value is what we're referring to as the gross domestic product. So the chart that you have on your screen indicates the gross domestic product that has been produced for three nations. We have Nigeria, we have South Africa, we have Cuba, where you can see on a graphical term how much has been produced along each and every country along the number of years from 1980 to 2010, where you can see how much production was happening within the three nations. So you can see that generally the graphs are all upward sloping, except beyond 2010, where some are going down. That is after the World Cup. South Africa was also going down. Nigeria was also going down, etc. So for this particular level of economics, we are not really interested in your interpretation of how much in relation to why the graphs are going up, why they are going down. For now, what you are required to understand is to calculate the gross domestic product, and for you to calculate eventually what you are referring to as economic growth. So this is just a highlight of the economy. So for those of you that are going to go further with the subject of economics, when you get to your MBA and you're doing your managerial economics or your economics for managers, that is where you are required now to interpret the phenomena that are happening there. But for now, we just want you to understand how to calculate gross domestic product, as well as how to use gross domestic product to calculate the value of economic growth. So in terms of how to calculate gross domestic product, there are three methods that are used to calculate gross domestic product. The first one is the production method or the value added method. The second one is the expenditure method or the final goods and services, the value of the final goods and services. Then the third one is the income method. This basically looks at all the incomes that are being received by the factors of production. So I'm going to explain each and every one of them and how you can use them to calculate the value of economic growth. So the first one, which is the production method, it basically adds the value that has been added along the production. So we understand that in terms of the manufacturing of a product does not just appear on the market as a fully produced product, but it goes through various stages in order for it to be presented on the market. If it is orange juice, we understand that the oranges have to be grown first. From the oranges growing, we need to extract the orange juice. From the orange juice extraction, there are also various value adding that happens within the process until we have the various orange juices that we have and their quality. So in general, we try to look at each production stage or each value adding stage, how much value has been added to the product up until we got the final value that we have of that particular product. So you'd find out that in terms of growing of oranges, you start with nothing, then maybe the value of a single orange gets to $1, and from there it's increasing. From the making of oranges, there's a value that is being added. Now it's starting at $1 to $1.50, and the value that has been added there would be 50 cents, etc., 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 etc. So you'd see that there are successive stages that we have there. that would be in relation to the adding of the value within that particular product. So we would add up the value that has been added at each stage of production up until it is presented within the market. Then we aggregate that total value with other values of other products for us to get the value of gross domestic product. So that is the value added method. Then the second one is the income method. So the income method, we measure the incomes that are being received by all the factors of production. So I understand that the factors of production, with your natural resources, with your labor, with your entrepreneurship, then you have your capital. So basically, these are the factors of production. So each and every one of these factors of production receive a particular remuneration if it is to be presented within the market. For instance, if you are employed, if you get in the factor market and you present your skills, you receive a remuneration for that if you're employed. And that remuneration, we are referring to that as wages and salaries, which is the income that you receive at the end of the month or between 2 weeks, whatever it might be, within a fortnight, depending with the different contracts that you have. So you'd see that for labor, you'd get wages. For natural resources, the remuneration there would refer to it as rent. Then for capital, if it is presented within the factor markets, you receive interest. And if you are to start an organization to combine your intelligence with the factors of production, as an owner of an entity, you'd receive remuneration in form of profits. The profits that you get would be your remuneration. So the summation of the wages that the factors of production are receiving, the rent, the interest, and the profits would give you the total value of gross domestic product using the income method. All right. Then last but not least, we have what is referred to as the expenditure method. So with the expenditure method, we try to look at how much the participants within the economy have been spending on various goods and services within the economy. So we understand that whatever that was produced is reflected within the goods and services market. And we also assume that everything within the goods and services market is going to be bought or is going to be spent upon by the households, the firms, the governments, and the foreign sector in terms of spending. So basically, we try to look at how much have the households spent in terms of acquiring the goods and services, how much have the firms spent in terms of investing in their capital, how much different the government itself spends sometimes in terms of acquiring factors of production, in terms of providing public goods and services within the market, healthcare, etc., etc., etc. So you'd see that we'll try to aggregate all of these elements from the expenditure element to try to get the value of gross domestic product. So in terms of the expenditure method, it is usually given by this particular equation, sometimes represented as GDP is equals to C plus I plus G plus X minus Z. I'll explain what C stands for, I stands for, G stands for, X minus Z. So C stands for consumption expenditure by households. So we're saying that households are going to be spending. So when they are spending, that spending, we are referring to it as consumption expenditure by households. Then I represents investment spending by firms. So we understand that firms, for them to operate, they need capital goods. And these capital goods, they also get them from the goods and services market, because some firms do not produce consumable goods. They produce capital goods. So with capital goods, they produce machinery, they produce your tractors, they produce your combine harvesters, they produce your computers, they produce various other elements. They produce various other elements that are used in the production space. So you'd find that we refer to that as investment expenditure. Then the government also comes into play by providing public goods and services, by providing healthcare, by providing security services in terms of policing, by providing elements like the various elements that we have in terms of the government departments providing within the markets. So you find out that that is also contributory in terms of the expenditure that is going to be happening within an economy. Then we have the foreign sector, which is X minus Z. So X represents exports, Z represents imports. So X is an addition to the spending or an addition to the gross domestic product, because whenever you're exporting goods and services to other countries, it's going to be presenting the country with income, and it's going to be growing the economy, and it's going to be creating employment within the economy. So hence, as a result, it's a positive. So that's why you see that it's a positive. Then we have a negative Z. A negative Z represents imports, and it is presented as a negative because it's indicating an outflow that happens whenever we're importing. The economy is being hemorrhaged, and hence, as a result, that would be presented as a negative to the total spending that is happening within the economy. So the summation of these elements here give us the value of gross domestic product. So whilst I'm still there, I need to highlight that all of these elements, either we are going to be measuring GDP from the expenditure element, or from the income element, or from the production element, they have to give us the same value within the economy. So I would want to go back a little bit to my circular flow of income and spending, which I highlighted earlier on. So you'd find out that within the economy, we stated that all of the spending within the economy becomes income, and all of the income becomes spending. And hence, as a result, the spending and the income that is happening is as a result of the production that is being produced by the firms. So hence, as a result, if we are to be frank enough, we are supposed to be getting the same value if you are to calculate gross domestic product from the spending expenditure method, from the income method, or from the production method, because we're simply saying that whatever has been produced is going to be spent upon by the households in terms of spending, and the spending that is happening by the households is going to be emanating from the income that they've received from the firms, and hence, as a result, we are supposed to be getting the same value. So that's why you see here that the firms spent on the factor market, and as they are spending on the factor markets, this is coming to the households as income. And that's why you see the wages, the profits, the rent, etc. And the income that has been received by the households would be spent on the goods market, and the same spending again becomes income to the firms in terms of the income that the firms receives. So at the end of the day, we're supposed to be getting the same value if we are to look at the three methods of production. All right, so I'll skip that one a little bit. So that's because of time. All right, so the gross domestic product is the sum of, from the expenditure method, consumption expenditure by households, investment expenditure by firms, government spending, expenditure on exports, minus expenditure on imports. Then there's something that we look at when we are trying to analyze gross domestic product, sorry. There's something that we refer to as gross domestic expenditure. So basically, gross domestic expenditure is simply a variation of the same gross domestic product, but it does not include the foreign sector. The foreign sector, which includes your exports and your imports. So if you are to exclude the impact of imports, the impact of exports on an economy, we're trying to see how much the local economy is demanding, how much the local economy is spending, how much the local economy is contributing to the total value of the economy. We look at what is referred to as the gross domestic expenditure. So the gross domestic expenditure indicates the total value of spending on goods and services produced within the country. So we're not including the goods that are going to be consumed in the external economy, or the goods that are going to be imported from other countries into the local economy. So in terms of us analyzing gross domestic expenditure, we simply add the three local participants within an economy, which are your households spending, your investment spending, and your government spending. So that's why you see that gross domestic expenditure only includes three elements, which is consumption expenditure, investment expenditure, and government expenditure. All right, so these are some of the variations. So I just want to look at some of the other variations. I'm seeing the activities on the chart, so let me just ignore it a little bit. I'll look at it once I get concluded. All right, then we have gross national product. So gross national product, again, is another variation that we can use if we want to analyze the performance of the economy in terms of how much the permanent residents of a nation have been contributing to the local economy. So gross national product is the metric that is used. So by definition, it refers to the production resulting from the employment of permanent residents within the South African economy. And for us to be able to derive gross national product, we use gross domestic product as our starting point. And the starting point of gross domestic product, we add primary income receipts minus primary income payments. So I'm going to explain what primary income receipts are and primary income payments are. So with gross national product or gross national income, which is the same thing, we are trying to look at how much the permanent residents of a nation have been producing or have been contributing in general to in terms of their productivity, regardless of their geographical location. So the primary income receipts simply refers to the incomes that the permanent residents are receiving from wherever they are as a form of remuneration for whatever they are doing. And the primary income payments would be the payments that we're paying the foreign nationals that are within the South African market in terms of their remuneration for the operations that they are producing within the local economy. So you find out that the difference between the two would be added or subtracted to gross domestic product, because that would highlight how much the permanent residents are contributing in terms of economic growth. So in a nutshell, we're simply saying that gross domestic product minus net primary income payments to the rest of the world, where the net primary income payments equates to the primary income payments minus the primary income receipts. So basically, we're looking at how much the payments have been received by the local residents, wherever they are, and subtracting the income payments or the income receipts that have been paid to residents of other countries within the South African market. So just to highlight the differences between the gross national product and gross domestic product. So gross national product aggregates the value of all the goods and services made by a country's residents and businesses, regardless of their location or production. So wherever the permanent residents are operating from, whether they're operating from the United States, whether they have branches in other countries, we try to aggregate those payments for us to get the value of goods and services that have been produced, and measure the production that is happening within the boundaries of a country. Within the boundaries of a country, no matter who makes it. Then these are the main highlights of what you are looking at. You see that on the map of the gross national product, we are basically looking at a single nationality. This one is an American flag, so please just see it from a South African perspective. Assume that these flags are South African markets. Then in terms of gross domestic product, within the same map, you'd see that you'll be having different nationalities. So to add up the total value of those different nationalities that are earning different elements within the economy. All right, then we have another variation that we refer to as net domestic product. So with net domestic product, we're trying to aggregate what is the net in relation to the productivity that has been happening within the South African market. So it's a variation again from gross domestic product. Now we are looking at the other elements like depreciation that we are not taking into consideration when you're looking at gross domestic product. Remember, this gross domestic product was simply gross. It was not netted. We did not subtract some of the costs that needs to be ascertained in terms of replacing some of the equipment that has been used to produce. So hence, we're supposed to deduct depreciation from gross domestic product for us to get net domestic product. We're going to be getting into some of the exam type scenarios that you might meet surrounding this in a moment. All right, so in conclusion, we've talked about gross domestic product, how you can measure gross domestic product, and how it can be used to differences that happens in terms of measuring the product. We use what we refer to as a real GDP to measure the value of growth within the economy. But sometimes we are not presented with real GDP because real GDP measures the gross domestic product at constant prices. You're going to be looking at that one. We are usually presented with what we refer to as nominal GDP. So I'll explain a bit on nominal GDP, then we get to real GDP. So on nominal GDP, we understand that prices do not remain the same along over time, as we're saying that the price of petrol in 2020 and the price of petrol in 2023, those two are different if you're to compare them. And if you're to use the current prices with the same production that happened in 2020, you would see that you would have an inflationary or an inflated figure that appears to be the economy is growing, yet the economy is not growing. So I'll just give a hypothetical example there so that we understand what I'm talking about. So suppose that in 2020, the South African economy produced, let's say that we are only, this is an assumption, so please bear with me, we are only producing 100 liters of fuel. Suppose we produce fuel by any chance. So suppose that in 2020, we produced 100 liters of fuel, and in 2023, we're in 2023, we also produced the same 100 liters of fuel. But now what is different is the pricing. In 2020, the price per liter of fuel was around 16 rand, 16 rand per liter, 16 rand per liter. And the pricing in 2023 for fuel, approximately, let's just say 25 rand, just for us to be able to calculate. So you can see that we have the same amount of production that has happened between 2020 and 2023. But what has changed here is the pricing. So if you were to calculate gross domestic product without considering the differences in the pricing, you'd see that in terms of the total value that has been produced in 2020, it's going to be 100 times 16 rand per liter. I think that gives you something like 1,006. So you just assume that it's in millions. So that will be the gross domestic product for 2020, assuming that is the only production that is happening. And for 2023, we are multiplying again the same 100 liters with the 25 rand per liter. That would give us something like 2,500. So if you're asked to say whether the economy was growing between 2020 and 2023, on nominal terms, you might assume that the economy was growing, but yet in real terms, the economy did not grow because the same production occurred over the 2 years. What is changed is only the pricing, and hence that is highlighting the inflation that is happening in between. So this is a perfect example of what we're referring to when we're talking about nominal GDP. Nominal GDP simply calculates the value of gross domestic product by the current prices of the products within that particular time. So hence as a result, that would not accurately reflect whether we're growing or whether we're shrinking as an economy, but that would be reflecting the inflation in the prices. But now, when you're looking at real GDP, we're looking at the base year prices. We're no longer looking at the prices that are there currently, but we try to aggregate the prices based on a base year. So a base year usually is selected based on the relative stability of the prices that would have been ascertained during that particular period. So you'd find out that it depends with the economy in question. They might choose a base year depending on how they were viewing the prices in general aspects in relation to how the economy was producing. So there's a table that is just down there below. I hope it is visible, which is highlighting nominal GDP in 2005, nominal GDP in 2013, then real GDP in 2013 at the 2005 prices. So we use the base year prices. For instance, at this particular time period, we would use 2005 because that would be the one with the most stable prices, or that we can use as a basis for ascertaining whether the economy is growing or not. So in 2005, you can see that 100 apples were costing 50 cents. That would give you a total value of 50 Rand, 200 bananas costing 25 cents, assuming that is the total production that is up, and 50 oranges at a value of 30 cents. That would give you the value of gross domestic product in 2005. In nominal terms, that would be 145. Fast forward to 2013, producing the same, now it's different. We are now having 150 apples at 1 Rand. Now the price is 1 Rand. You can see that the price has increased, the production has increased. But you can see that both the pricing and the production increasing would impact on the total value that we're going to be having in terms of the elements of productivity of these particular products. So the total value there, you'd see that it's, so this one is a mistake. I think they wanted to put 100 on apples and 150 on oranges. You can see that they vice versa, the two. So let's just assume it's the same thing. All right, so 150 apples at 1 Rand would give you 150. 200 bananas at 40 cents would give you 80 Rand. 100 oranges at 50 cents would give you 50 Rand. So the sum of these elements would give you a gross domestic product in 2013 of 280 Rand. And from a layman's perspective, a person maybe that does not have an understanding in terms of whether this is nominal GDP or this is real GDP, you might say that the economy is growing, everything is fine, or everything is moving smoothly. But before you know it, you'd realize that even though you have, on a figuratively perspective, a growth in terms of gross domestic product, you might realize certain elements within the economy are not adding up. You'd realize that the economy, though it is assumably growing, but in terms of employment, you're actually going the reverse of the direction that you're growing. And in terms of the standards of living, you'd realize that people are actually becoming poorer and poorer because their incomes are not changing, but the prices are increasing, but yet you're saying the economy is growing. And that would, at the end of the day, realize you'd realize certain elements growing and other elements within the economy are basically being affected by these same elements. So hence, as a result, you'd see that it would be affecting the economy in one way or the other. But in order for us to ascertain whether there was growth or not, we'd look at it from the real GDP perspective, using the same production, using the same price levels, with how much has been produced, you are able to see whether there is growth or whether there is no growth. So assuming that 150 apples were produced in 2013, which is the same 150 that were produced in from nominal terms, applying the base year pricing, which is 50 cents, 25 cents, and 30 cents, you can see that the total value of gross domestic product sums up to 155, which is indicating a greater value as compared to the previous value that we have here, which is 145. So there we can say the economy is growing because the real GDP is growing. So we want to look at how you can calculate economic growth. So the formula that is used to calculate economic growth, let me just highlight that one. So the formula that is used to calculate economic growth, it is used as current years. We have to type the whole formula. So it's current year's GDP. So basically we're talking about real GDP minus previous years. So depending with the time period in question, previous year's GDP divided by the previous year's GDP times 100. If you multiply that by 100, you get a percentage of either a growth or a negative growth. So current year's GDP minus previous year's GDP divided by previous year's GDP times 100 would give you the value of gross domestic product. So applying that to this particular example on real terms, you can see that real GDP in 2013 amounted to 155. and in 2005 amounted to 145. So 155 minus 145 over 145 would give us the value of economic growth. So in simple terms, it's 155 minus 145 divided by, so that all of that divided by 145, then we multiply that by 100. So if you have a calculator nearby, you can use it to calculate. So 155 minus 145, I think you get a 10. 10 over 145, what do we get as the economic growth rate for those with calculators near them? Let's see, so it's 10 divided by 145 times 100. So I think you get something like 6.89%. 6.89%. So that will be the economic growth rate. So for this particular example, it will be 6.89%. So that will be the economic growth rate. So you'd see that is the same scenario that we have on these particular elements from a nominal perspective to a real perspective, where you have GDP at constant prices, gross domestic product at current prices, and where at constant prices is representing the real GDP, at current prices that represents the nominal GDP. So you'd use the same to calculate the growth rates that you see here on these particular elements. So current year's GDP minus previous year's GDP for you to get the economic growth rates that you have here up until 2018 from the year 2000. All right, so that brings us to the end of today's presentation. But before we close, I just want us to look at some of the exam type questions that we can meet in relation to the subject of economic growth, etc. So question number 1 is stating that which of the following does not represent a key macroeconomic objective or macroeconomic variable, not objective. It's saying that which of the following does not represent a key macroeconomic variable. 1, we have the unemployment rate. 2, we have the inflation rate. C, we have the gross domestic product. D, we have the income distribution. Then E, we have the population growth rate. So the key macroeconomic variable basically means that the macroeconomic objective, a key macroeconomic objective within an economy. So we've talked about the macroeconomic objectives. We talked about full employment, which includes unemployment rate. We talked about price stability, which encompasses the inflation rate. We talked about gross domestic product, which is encompassed within economic growth. We talked about equitable income distribution, which is within the income distribution, but we did not talk about population growth rate. So hence E is the answer that that is required on number 1. Then number 2 is stating that net domestic product equals to gross domestic product net of. So I think we talked about the net domestic product when we were talking about the variations of gross domestic product. Net domestic product equals to gross domestic product net of. We talked about depreciation or consumption of fixed capital within the economy. We did not talk about inflation, indirect taxes, subsidies, etc. We talked about depreciation. So the answer on number 2 is E, which is depreciation. So for you to calculate net domestic product, you say GDP minus depreciation, then you get your net domestic product. Then number 3 is stating that for a given year of statistics, South Africa found out that nominal GDP calculated at market prices was different from nominal GDP calculated by the income method. Which of the following would be the difference? So you'd see that the difference between the incomes and the prices within the markets obviously would be in relation to indirect taxation and subsidies, because we understand that whenever you receive your income, it has to be taxed, and there are various subsidies that the government also includes in terms of providing assistance to other firms, and as a result, that would be part of the differences between the income method and the expenditure method. Then number 4 is stating that GDP at prices will be greater than GDP at dash prices because of. So we talked about GDP at constant prices and GDP at current market prices. We said at constant prices is the real GDP based on a base year perspective. At current prices is the nominal GDP based on current prices. So the difference between constant and current prices usually comes as a result of inflation. So let's see of the elements that we'll be having here. So it's saying that GDP at dash prices will be greater than GDP at dash prices because of inflation. So understand that the GDP at current market prices will be greater than the GDP at constant market prices because of inflation, which is option B, because the current market prices, if they are greater than the constant prices, it means that there's inflation that happened in between. So 4 is B. Then 5 is stating that since 100 Rand note was first introduced, its value has, since 100 Rand was first introduced, this hasn't been in relation to we didn't talk about the monetary economy, but I'm sure with what you understand now, you are able to answer question number 5. It's saying that since the 100 Rand was first introduced in South Africa, its value has it decreased terms? Is it decreased in real terms, or is it increased in nominal terms? So which of the options that we have there? So it's saying that decreased in nominal terms. So obviously in nominal terms, the South African rand, we cannot really say it has decreased. So I would not choose any of the options that have decreased in terms of nominal terms. Then it says decreased in nominal terms and decreased in real terms, increased in nominal terms, increased in real terms, decreased in real terms, although nominal value has remained unchanged. So obviously I'll choose option E, because we understand that in real terms, how much you are able to purchase currently using a 100 Rand note with how much you were able to purchase previously, either in the year 2000 or so, is totally different. We talked about how much fuel you were able to purchase in 2020 and how much fuel you're able to purchase currently as a result of inflation. You'd understand in terms of real terms, it has decreased, but the nominal value, it hasn't changed. So the option there is option number 5. Then we move on to the last one, which is, okay, just allow me to scroll down a bit. So it's 8 o'clock. I think we are now about to close. So the value of gross domestic expenditure is, so we've been given the various elements on the table: consumption expenditure, government expenditure, depreciation, exports, imports, then capital formation, which is investment expenditure by firms. So what is the value of gross domestic expenditure? So we talked about gross domestic expenditure and gross domestic product. Those two are different. Gross domestic expenditure includes the local participants elements and does not include the foreign sector. So we are looking at consumption expenditure by firms plus investment expenditure by firms plus government expenditure. So I said consumption expenditure by firms. It's consumption expenditure by households plus investment expenditure by firms plus government expenditure. So basically we're looking at these 3 elements, the first 2 one and the last one, and we're excluding the rest of them because they're not part of gross domestic expenditure. So it's 10.5 plus 3,000 minus 2.2. 10.5 plus 3,000 minus 2.2. Those are the elements that you look at when you're looking at gross domestic expenditure. So 10.5 plus 3,000 plus 2.2, that would give you a figure of 13.5 plus 2.2, that's 15.7, which is option E. So if you had to add these 3 elements, you get 15.7. Then it says the value of net domestic product would be, so we understand that with net domestic product, we are supposed to deduct from gross domestic product depreciation. So now it's gross domestic product minus depreciation. So for us to get the gross domestic product, we are now including the foreign sector. So we're now including X minus M. So on top of 15.7, we're going to say plus 1,200 of exports minus 1,000 of imports, which basically gives you a net plus of 200. So the 15.7 plus 200 gives you 15.9 minus depreciation of 500, which gives you a net domestic product of 15.4, which is option D. All right, so that brings us to the end of today's session. I don't know if you have any questions. Let me try to check on some of the questions that we presented. All right, I see some were looking for the page. Yes, go ahead.
I just wanted to find out, it's the first time that I'm attending. Is it possible to go to the recordings?
All right, yes, you have the recording. You will have the recording. I don't know from which group you are joining me from. There's another group that I sent the link. You can inbox the number that sent the link on that particular group for you to get the recording. If you are not in the main group, because I sent this link on different groups.
Okay. I'll just email. I'll just respond to the WhatsApp.
All right. Okay. So someone is asking, what is the formula for GDE, which is gross domestic expenditure? So the formula for gross domestic expenditure, let me just go back to my notes. We were talking about it some few minutes ago. So it's simply a summation of consumption expenditure by households plus consumption expenditure, investment expenditure by firms, plus government expenditure. So all of those three elements, this is the formula for gross domestic expenditure here that I'm highlighting on the screen. C plus I plus G, consumption expenditure by households, investment expenditure by firms, as well as government spending. C plus I. Anyone else with a different question? Anyone else with a different question? All right. So this was just a snippet of some of how we're going to be conducting our sessions. You're going to be having a recording at the end of each session, as well as the notes to assist you with either revision or whatever. All right. Anyone else with a question?
Hi.
Yes.
Hello.
Hello.
Yeah, can you clarify again on income method?
All right. On the income method, let's try to go back then. All right. So we started talking about the production method. Then we talked about the income method. Then we lastly talked about the expenditure method. So someone was asking, I've remembered, someone was asking about the production method. I'll talk about it. Let me start with the income method. So income method, you are simply supposed to add the remuneration that is being received by the factors of production. All right. So the remuneration that is being received by the factors of production are usually highlighted in terms of wages and salaries, plus rent, plus your interest, plus the profits for you to get the value of the gross domestic product. All right. But there are scenarios where they ask you, what is the difference between the expenditure method and the income method gross domestic product? So we'll be looking again at variations that you might be presented with. So you find out that if you calculate the value expenditure method, if there is a difference, the difference can be reconciled by taxation and subsidies. So we're supposed to add taxation because we understand the incomes are taxed, and we're supposed to deduct subsidies because the subsidies, these are the assistance These are the assistance that are provided by the government to the firms, either in various ways for either for them to continue to produce or for them to remain within the markets, etc. So you find out that they'll be given subsidies. So hence, as a result of that, for us to reconcile that, the GDP has to be added with taxation and subsidies. But in general, for you to calculate the gross domestic product from the income method, you're simply supposed to add wages plus rent plus interest plus profits. All right, are we together? Then with the income method, or the production method, or the value added method, you are simply supposed to add the value that has been added at each and every production value chain along the production value chain of the product. So the addition that will be happening along the production value chain would be added together up until we get the value of gross domestic product. So any value that has been added from the previous value on top of the work in progress, etc., you'll be getting the value of gross domestic product. All right, anyone else with a different question? What is the formula? Page 20 of the module guide says you are not required to know how to calculate these methods for the purposes of this particular course. All right, so one thing that I would tell you with economics is you need to be prepared for everything. You need to be prepared for everything, even the things that are not within the study guides. You need to be prepared for them in case they are presented to you. You have no one to ask, you have no one to complain to, because they say that we gave you the what do you call this textbook, the prescribed textbook. So everything that is within the prescribed textbook that has to deal with the subject of macroeconomics, you are supposed to have an understanding of it, because you'll be asked on how to calculate economic growth. You'll be asked on how to calculate these particular elements. So you'd see these questions that I was presenting to you. Where are they? These ones. This is coming from your workbook, from the Mancosa workbook, where they are requiring you to calculate gross domestic expenditure, where they are requiring you to calculate the value of net domestic product. So all of these elements are emanating from the elements that you're talking about, the income method, the production method. So you might be presented with questions like these, and if you're not prepared to answer them, you're going to see fire in your exam. So I would advise you to also be proficient in terms of the calculations. Any more questions? Anyone else with a question before we close? All right, so that means that we are all covered. So basically, these are some of the scenarios that you're going to be presented with within your exam type scenarios. And in terms of any further elements, it will be communicated with the group. For those that would want to continue with us for the subscription, you can communicate within the groups with either James or the number that sent the link, depending on where you got the link from. All right, so for today, I think let's call it a day. Until we meet again, have a pleasant evening.
And goodbye.
Thank you.